Hello, I'm Ben from Modern Graham, and today I'm going to bring you 10 high yield dividends. And these are suitable for defensive investors. I was going to have it be only 5, but I thought, why not expand the list to 10? So, what we're going to do is we will first talk about companies 6 through 10, and then I will go into a little bit more detail about companies 1 through 5. So, without further ado, let's go ahead and get into it. The first company this week is the Interpublic Group of Companies. This is number 10 on the list. This company is in the communication services and media diversified industry. It is suitable for the defensive investor. And when we look at the intrinsic value using the Modern Graham value formula, which is derived from Benjamin Graham's The Intelligent Investor book, we get a value of $34.98. The recent price was $26.30, and so we find this to be just a little bit fairly valued. Our margin of safety is about 25%, so this one has just gone over the margin into the fairly valued range, but the dividend yield on it is 4.11%, so it is definitely worth checking out. Next on the list, we have the Truist Financial Corp. This is a financial services and a bank. It is suitable for the defensive investor. And looking again at the Modern Graham valuation, we value it at $73.20 for this one. Now that one, the current price is $44.20. So this one is undervalued at 60% of its intrinsic value, and the dividend yield is 4.2%. The market implied growth rate on this one is only 1.17%. So the market is thinking that it will not grow very much, but the actual historic growth is at about 4.7%. So the market is pricing in a little bit of a lower growth rate. So you can use these figures down here, the Modern Graham value based on 3% growth or on 0% growth, to help figure out other possibilities as well. Now, moving on, number 8 is U.S. Bank Corp, another bank on the list. This one is a defensive investor stock, and looking at our valuation, it is 50 sips, 50 sips. That one is currently trading at 40.80 sips, so it is just barely undervalued. And the dividend yield on that one is 4.3% with a market implied growth rate of only 0.63%. So there might be potential there as well. Number 7 on the list, we have Key Corp. This is another bank, and it is a defensive investor stock. The Modern Graham value on that one comes to 50 sips, 68. The growth estimate on that is 9.67. So that one has seen a lot of growth in recent years, and so the Modern Graham formula and setup is estimating continued growth at about that rate. But then we also have the current price is only 16.20 sips, so it is significantly undervalued, and that is because the market is implying a negative growth rate. The market thinks this one will shrink, and it might, but even if it continues at 3%, which is significantly less growth than it has seen, then it will still be, it should be priced much higher than its current price. The dividend yield on this one is 4.61%. Moving on, number 6 on the list is Paramount Global. This is a media company, and it is suitable for the defensive investor. And actually, all of these, it should say that they're also suitable for the enterprising investor. So I'll have to fix that in my spreadsheet setup. But anything suitable for the enterprising investor is also suitable. No, other way around. Anything suitable for the defensive investor is also suitable for the enterprising investor. The Modern Graham value on Paramount is $53.22, and the current price is only $19.46. And so it is definitely undervalued. The growth estimate on this one from Modern Graham is only 1.6%. But the market is implying that we're expecting that it will go down 2.1%. So there is a disconnect there as well. Even if it has zero growth, it would be worth more than the current price. The dividend yield on this one is 4.91%. Now moving on to the top 5 high dividend companies for the defensive investor. At number 5, we have Intel Corp. This one is, of course, in the semiconductors field. And let's go into detail about how it is suitable for the defensive investor. So when we're looking at the defensive investor test, we have to pass 6 out of the 7. If it is a financial company, which Intel is not, then we would eliminate this one and give them a pass, and then it would have to pass all of the others. But Intel, the number 1 is adequate size. It is greater than 2 billion in market cap, so it gets a pass there. Current ratio is just under the requirement of 2. It's at 1.8 SIPs, but that does not surpass the requirement, so it is a fail there. It has had over 10 years of positive earnings per share and over 10 years of dividend payment, so it gets passes on those. It has grown more than 33% in the past 10 years, so it gets a pass there. It has a PEMG ratio, that is the price over a normalized earnings per share, and that is below 20, so it gets a pass there. And then the moderate price to assets, it gets a pass here because the price to book, which is 1.07, is below the threshold of 2.5, and also the PB, the price to book, times the price to earnings modern gram is lower than 50, so it gets a pass there. For the enterprising investor, it should actually pass this, so I need to fix that in the spreadsheet as well, because it has to pass 4 out of the 5, and you can see that it is here. It has a 4, but it is giving it a no for that, so we'll have to double check that. But the current ratio is greater than 1.5, so it passes current ratio. Debt to net current assets is not less than 1.1, so it gets a fail there. It has over 5 years of positive earnings per share, and it currently pays a dividend. And then it has growth that is greater than the earnings are greater than 5 years ago, so it gets a pass there. Value-wise, let's take a look. We've got earnings here, and you can see this is the calculation of earnings per share. We take a weighted average of the last 5 years, with the most recent having the strongest weight, and we look at the estimated for the current year. Estimating the growth, we take the current earnings per share, and then we take the earnings per share from 5 years ago to calculate the total growth, and then we take the average of that to figure out, then we put a safety margin in, and we get our growth estimate of 6.03. So those are the factors that go into our value formula, which you can see here. We've got earnings per share, and then we have to calculate growth. Then we can use those to calculate value. So earnings per share of 4.08 and growth of 6.03 results in a value of 83.99. Current price is 26.31, so this one is undervalued. Then we look at the market implied growth rate of -1%. The market is saying it is going to shrink. If you think that it is not going to shrink, that it might just stay the same and earnings will not go down on this one, the normalized earnings, I should say. I mean, we're already factoring in a drop in the earnings, but we're not necessarily expecting that the earnings will go down from the weighted average. And that is really where the formula, I think, works well, because it is already factoring in some of that business cycle to figure out where we should go. The dividend yield on this one is 5.27%. Now, moving on. Number 4 on the list is the Scott's Miracle Grow Company. This one is in agriculture. I think we all know what Miracle Grow is if we've done any gardening at all, or gardening at all, literally in your yard. You probably know what Miracle Grow is. Anyway, defensive investor. We have a market cap over 2 billion, so we pass there. Current ratio over 2, get a pass there. Positive earnings per share for 10 years. Dividend payments for over 10 years, we get a pass there. Growth of over 33% over the last 10 years, get a pass. PEMG is less than 20, we get a pass there. And the moderate price to assets here, we don't pass. The price to book is greater than at 2.5, and the price to book times the PEMG is just over the threshold of 50, so that's a fail there. But overall, we still get a pass for defensive investors. The same thing here, enterprising investors. This should be green. We have a pass for current ratio. We have a fail for debt to net current assets, which this is really the one that I see companies failing the most for the enterprising investor. That is the hardest threshold to meet for that field. Then earnings per share has been positive for 5 years. Dividend, it pays one, and earnings per share are greater than 5 years ago. So it should be suitable for the enterprising investor, even though it is also suitable for the defensive investor. So it has two ways that it becomes suitable there. Earnings-wise, you can see, again, we have estimated negative earnings for the current fiscal year, but our earnings per share are still actually not too bad. We're down significantly from last year and the year before, but it is still a good growth from 5 years ago, and we would expect to see further continued growth. Estimating the growth, we take the current estimated earnings per share and the 5 years ago earnings per share to get a total growth of 61% over 5 years, which is an average of 12.25%. Then we have a safety margin kicked in there, and then so we lower that growth estimate to 9.2%. Using the earnings per share of 4.64 and the growth of 9.2%, we end up with a value of 124.80, which is significantly more than the current price of 43.43, meaning that this one is undervalued. Then we look at the market implied growth rate of only 0.43%. So they're expecting that the earnings per share will not grow much further. Dividend yield is 5.84%, which is a pretty good dividend yield, if you ask me. Moving on to company 3 on the list, it is LyondellBasell Industries, a chemical company, and this one passes for current market cap. It fails for current ratio. It passes for earnings per share and dividend payments, and for growth. It passes for PEMG being under 20. It passes for the moderate price to assets because the PB is lower than 2.5 and the PB times the PEMG ratio is lower than 50. So this one is suitable for the defensive investor. The current ratio is greater than 1.5, so it passes the enterprising investor's first test. Debt to net current assets is more than 1.1, so again, this one fails for financial condition. It has a positive earnings per share for 5 years, and it currently pays a dividend. Then it has growth in earnings per share, so it passes that. It would be suitable for the enterprising investor, even if it was not for the defensive. Value, let's take a look here. We've got our earnings per share. Again, the normalized earnings per share are less than the estimated this year, but still greater. So this one has had good growth for several years now. So then we can take the current earnings per share and the previous earnings per share to get our total growth of only 16% on this one. Average growth is 3.25%. So with the safety margin, we're estimating a growth estimate of 2.45%. Then we take those numbers, 12.68 as the current earnings per share modern gram, and the growth estimate of 2.45% to get a value of 169.95, which is significantly more than the current price. Again, this one is undervalued. Market implied growth rate is negative 1.28%, and the dividend yield is 5.87%. Company 2 on the list is Enterprise Products Partners LP. This is an oil and gas company. It passes for the current market cap. It fails for the current ratio. The current ratio on this one is only 0.87. The earnings per share have been positive for over 10 years, and it has paid a dividend for over 10 years. Growth is greater than 33%, just barely. So it gets a pass, though. And PEMG is less than 20. It gets a pass there. And the PEMG times the price to book is less than 50. So it gets a pass there. It is suitable for the defensive investor. Enterprising investor, it fails on the current ratio, but passes on all of the other tests. Debt to net current assets. That one I probably should check the formula here too, because that doesn't quite seem like the way I want it to be, but I will check that. Regardless, it would be suitable for the enterprising investor because it is suitable for the defensive investor. Looking at the value formula, we have earnings per share that have grown every year in the regular, except for there's a little bit here in the 2020 dipped a bit, but the normalized has grown every year. Earnings per share is 2.13, and the 5 years ago was 1.49. So total growth is 43 and a third. Average growth is 1/5 of that at 8.67, and the safety margin brings that down to 6.5%. Then we get the modern gram value with those numbers at 45.89. The current price is only 23.83, so this one is undervalued with a dividend yield of 7.5%. That is one of the highest out of the many companies that I follow. And company number 1 on the list is SL Green Realty Corp. This one is a real estate investment trust, and it passes the current market cap. It fails the current ratio. It passes on earnings per share and dividends. It passes on growth. It passes on a low PEMG and a low moderate price to assets test. It sits out of 7 for the defensive investors, so it passes that. Enterprising investor, it would pass on current ratio. It would fail on debt to net current assets. Passes on years positive for earnings per share and a dividend and growth. So it would pass on its own for enterprising investor, but it automatically would qualify for them anyway because it is suitable for defensive investors. Looking at the value, we can see that the current year's earnings are estimated to take a big hit, which is expected with the real estate market going through a bit of turmoil this year. But earnings per share modern gram, the normalized earnings are still pretty good and higher than they were 5 years ago. So that's what we'd use to calculate our growth estimate. Total growth over the last 5 years is 47.12%. Average growth is 9.42%, knocked down by the safety margin. We get to 7.07%. And then using those figures, we get a value of 79.68, which is more than the current price, and it is undervalued. The dividend yield on this one is a whopping 9.41%, so it would be worth checking out. Now, that is the whole list. Be sure to stick around for the next couple of weeks. I'll be looking at each of these companies in even more detail on the channel. So check that out. And also, down below, there's a link for a free valuation calculator. Be sure to get a hold of that so you can look at other companies on your own that you might want to apply my formula to. So that is it from me. Thanks for watching, and I will catch you next time. Take care.